Hi, I'm Mike Graham with John Graham and Associates, and I want to talk with you briefly this morning about some things we're hearing from our clients. As we all know, the media pushes us from euphoria to fearfulness in basically the same breath. And how do we make sense of investment decisions when we've got this noise and this chatter all around us is a question that we're receiving from our clients quite a bit these days. And so we come back to, we've got to have a process. We've got to have a rules-based investment process to guide us through. And the rules at John Graham and Associates are pretty clear. We basically recognize that the markets can move in three directions, right? The markets go up, they go down, and they go flat. We want our clients to be in a position that they do well in all three directions that the markets go, that they participate when things are up. So generally, in a study going back to 1934, something like 90% of the 5-year periods, so the 5-year cycles, 90% of them since 1934 to 2018, the markets have finished ahead. So in order to participate in the up markets, we need to have stocks in the portfolio. But we know that isn't always the case, and that history is not a guarantee of future results. So we've got to be prepared for those down markets. We want to have protections in place in the portfolio when things turn south. That doesn't mean our clients never lose money, but we want to lose less than the indexes. And then the third direction, as I mentioned, our markets can go flat. We want our clients to be paid to wait in those flat markets. We want them to receive dividend income in those markets. Similar to a farmer who wouldn't just have their field grow with weeds and hope that the ground is going to appreciate enough to make them enough money. They would plant corn and beans. They'd sell the corn and beans and make income, yield, and have growth on the underlying asset. Same thing with apartment buildings and rental houses. You wouldn't leave them vacant and just hope we're getting appreciation off the asset. We want income off of those assets as well. Same thing with our approach to stock investing. We want dividends coming in to pay our clients income so they can be patient in those flat markets and wait for those up markets to return. So our basics, our rules for investing are diversify, invest internationally. We want to go anywhere where we think there's investment opportunities. And right now, something like 3/4 of the world's investment options are outside of the US. So we wouldn't ignore 3/4 of our choices and say we're making the best decisions. We've got to be able to shop anywhere globally. We believe strongly in looking for undervalued companies. It matters what you pay for a stock, like it matters what you pay for any asset. If we pay less for it, we've got less risk involved. Bad news doesn't hurt as much if we've got a lower price than if we've got a higher price. So we're looking for leaders of industry that we think are undervalued, that last but not least, pay dividends. You've heard that word a few times from me this morning. So we're looking to participate in up markets, have protections in down, have income paying us to wait in those flat markets by sticking with the investing basics of diversifying, investing internationally, looking for those undervalued opportunities, and getting paid dividends. And the overwhelming theme through this comment is making sure that we've got time. If we've got a 5-year period of time, generally that's enough to get through a market cycle. Not always, but most of the time. So remember, stocks for the long run, through euphoric and fearful times, cash for the short run. This is Mike Graham from John Graham and Associates. Thank you.